Hello and welcome to Livewire's Buy, Hold, Sell. I'm Selby, and today we're taking a deep dive into the tech sector. Tech is off to the races in 2024 with investors betting big on artificial intelligence. So where can you find the next great tech darling? To find out, we're joined by Sam Koch from Wilson Asset Management and Andrey Mironenko from Alphinity. Thank you so much for joining us today, guys. As I mentioned in the intro there, artificial intelligence is all the rage right now, but there's not a lot of exposure on the ASX. Sam, I'm going to start with you. Are you investing in AI locally, and if so, how?
We do, and we think that there is a lot of ways that you can actually invest in artificial intelligence on the local bourse. As a starting point, there are companies that are leveraging AI to sell more products, like Dicker Data. There's companies that are leveraging AI to reduce their cost base, like Temple & Webster. And then as companies utilize AI, they're effectively increasing their demand for data center capacity. So companies like Nextdc and Macquarie Telecom, GDC that we've got a large holding in, and Megaport as well benefit. And then lastly, data center capacity is actually quite capital intensive. And so the whole entire supply chain will ultimately benefit from this demand. And we're playing that theme through Southern Cross Electrical, which is an electrical contractor. So it's one sort of trend, but the opportunity is multifaceted.
There was a lot of names in there. Are you also finding a lot of opportunity on the ASX when it comes to AI?
There are definitely opportunities. We're investors in Zero, which has launched Just Ask Zero, which is a generative AI copilot. Then, of course, the data center theme, names like Goodman Group provide us that exposure. And also companies like Data3, which is the largest reseller of Microsoft in Australia. That includes, of course, Copilot, and there is significant opportunity for them with services and consulting and implementation around that as well.
Okay, while tech has performed exceptionally well in recent times, it is quite volatile. Are there any risks that you think investors need to be aware of?
There are always risks, and of course, tech, as any long duration stocks, has exposure to interest rates, and then the broader thematic of generative AI. I think we still need to see proven use cases that actually scale to prove that demand, for example, for data center capacity and compute, is actually sustainable and comes from inference and usage of the products as opposed to just developing the large language models.
We saw this battle between profitable and unprofitable tech, I guess, over the last few years. Is profitability still important?
It's really interesting. As far as the risks is concerned, I think the number one risk that are facing technology investors is actually the sustainability of revenue growth. And I talk about that in the context of profitability as well, because there are macro concerns out there. And a lot of these companies cut their costs aggressively during 2022 and 2023 to address profitability. So if a tech company, we're all tech growth investors, if a tech company can't sustain revenue growth expectations at the cost of profitability, then I think that's at the risk of derating as a result. So I think that's a genuine risk.
Okay, looking out over the next 12 months, what key factors do you think will be important to investors, particularly when they're investing in those tech stocks?
For us, the sector is largely idiosyncratic, it's largely stock specific. However, having said that, as a sector overall, obviously interest rate expectations are key. So keeping an eye on that, where's the market, what are your strong views? And then secondly, it's actually the macro as well, because inversely, tougher macro environment, investors are going to be looking for growth elsewhere outside of cyclicals, and potentially interest rates are going to be cut in that environment. So that could boost valuation. So that's a couple of things that will drive the sector.
Okay, over to you, Andrey. Do you agree? What key factors do you think will drive success in tech investing over the next 12 months?
So our process at Alphinity is heavily focused on earnings and positive earnings surprises, so profitability is crucial. What I would say has been increasingly important over the last 12 months or so for the market is profitable growth. So the indicators such as Rule of 40 continue to be important, but I think there is growing recognition that a percentage point of revenue growth, all things being equal, is more valuable than a percentage point of margin. So I think what the market wants is earnings upgrades and positive earnings surprises, but driven more by top line, sustainable top line growth, as opposed to just purely margin.
Okay, let's get into buy, hold, sell now. First up today, we have Life360. Its share price is up a whopping 114% since the beginning of the year. It helps families track each other and their pets. Andrey, I'm going to start with you. Is it a buy, hold, or sell?
That's a buy for us. We are excited about the advertising opportunity that they have announced. They have a very high value, large, engaged user base, over 66 million monthly active users, skewing to US and other developed markets, families, so a high value demographic, very valuable to advertisers. And they have a rare data set in their location data, which they can monetize in that advertising. In addition, there is a lot of option value for this company to monetize this 66 million monthly active users. They're looking at expanding from just teens into younger kids, pets, and elderly, so to provide a broader range of services. They've also looked in the past and will continue to look at lead generation, for example, for auto insurance, leveraging their unique driver safety data set, and things like fintech for teens as well. And we see potential for margin expansion through operating leverage over time as advertising comes at a higher margin compared to subscription revenue because of lower take rates from Google and Apple.
It listed on the NASDAQ in June and it's rated as a strong buy among the brokers. Sam, do you agree, and is it a buy, hold, or sell?
We do agree. It's actually a conviction buy from our perspective. The stock has a really strong customer value proposition. These guys have 66 million monthly active users and 2 million paying circles per month. And they've been able to grow that 20% year on year out despite material price increases. And if you look on the App Store on Apple, you actually notice that they're actually ranked quite high as well. The CEO, in our opinion, is actually world class. He's steered the business through a number of crises, including TikTok, COVID, and has actually been able to add additional revenue growth drivers within new verticals, as you alluded to, but also the tile acquisition, and now finally the marketing opportunity that we're really excited about. It's trading on 30 times EV/EBITDA with over 50% earnings growth forecast. For us, the catalyst for it to continue to re-rate will be, I guess, addressing those advertising revenue opportunities.
Next up, we have data center operator Nextdc. Its share price has lifted around 28% since the beginning of the year and is rated as a strong buy among the brokers. Sam, staying with you, is it a buy, hold, or sell?
It's a buy for us. As we alluded to earlier, the AI thematic is significant. It's driving increased demand for data center capacity. Couple that with the ongoing drive for cloud computing. We believe that the demand supply imbalance within their target markets is actually shifting in their favor. And you can see that as, the price per megawatt has actually been increasing and returns have been increasing on capital. So we're attracted to that thematic. We acknowledge that the valuation is punchy. It's trading near all-time highs in terms of its valuation. But we believe that the recent $1 billion of capital that they raised is indicative of what they believe as far as the contracted demand pipeline is concerned. And so it can hold its multiple and just grow in line with earnings growth. So it's a buy for us.
Andrey, do you agree? Is the valuation justified here, and is it a buy, hold, or sell?
I think it's a hold. I'm not sure the valuation is fully justified. To me, the stock is discounting continued long-term growth. And notwithstanding the strengths of the AI thematic, this growth in compute demand is so far coming very much from training the models. And to prove that this demand is sustainable, we actually need to see meaningful demand to come from inference, so from actual usage of the models. And so far, we haven't seen any evidence that there is a use case of a scale of Google search or anything like that that would actually drive this large inference demand. In addition, the geographic mix. So I'm not completely convinced that a lot of AI models will be built in Australia. Most Gen AI models are built by US companies. You can see demand in China and Europe. It's harder, other than government, to see who would actually invest in this at scale in Australia. And even Nextdc themselves acknowledge that very little of their current demand comes from AI. So far, they're just benefiting from tightening in supply demand in data center industry. But how much of that tailwind will actually materialize for them, I think is open to debate.
Okay, next up today we have IT services provider Data3. Its share price has fallen around 3% year to date. Andrey, last one for you. Is it a buy, hold or sell?
It's a buy for us. It's one of the genuine beneficiaries of AI thematic in Australia. As I mentioned, they're the largest reseller of Microsoft in Australia, so they're well positioned both to resell Microsoft Copilot and Microsoft AI-enabled Surface PCs as well. But then more importantly, they're well positioned to sell services around that. They're now in the process of conducting a number of AI readiness audits for government and private sector organizations, some of which we expect to convert into larger implementation programs and drive services revenue. In addition, it's a very high quality business. It's very cash generative. It has been growing double-digit earnings consistently without needing almost any capital, which we see as a high quality business.
Okay, that said, it is quite expensive. It trades on a PE of around 30.6 times, but it was recently upgraded by both Morgan Stanley and Evans & Partners. Sam, last one for you. Is it a buy, hold or sell?
Data3 is a sell for us. Whilst we acknowledge AI is definitely a benefit to Data3 longer term, we think that potentially it's going to take a little bit longer than the sell side is suggesting within their models. In the shorter term, you've got the potential risk of a macroeconomic sort of softness weighing on demand from their corporate and government clients, and that's something that we're a bit mindful in the short term. You know, it's trading on, as you said, over 30 times PE, which is about sort of 80% higher than pre-COVID levels. It's a consensus buy, to your point as well. So from our perspective, they're probably better places to allocate capital.
Okay, we asked our guests to name their top pick within the tech sector today. Sam, I'm going to start with you. What's your favourite tech stock?
I've come with EML Payments. So EML is a conviction buy from our perspective. There's evidence that the turnaround in that business is actually happening. So you've got the old CEO or the old management team have actually divested and sold a number of underperforming divisions, plus the previous hurdles around their growth rates or attracting new customers within their UK business have recently been lifted. So that's, from our perspective, that's evidence that they're doing the right things, both from a shareholder and a regulatory perspective. That's then enabling them to focus in on their core business. So this is reloadable, gift, and digital cards. And this is a business that the market is familiar with and actually has been quite attracted to in the past. The stock's trading on sub 6 times EV/EBITDA. We believe the stock can double just based on that valuation alone. Wow. And what's interesting enough is that you look at, it's trading at about 90 cents today. The new CEO that came in earlier this month has an incentive package which, if he's successful, strikes at about $1.50 share price. So we think there's a lot of opportunity there for the market to start to get more comfortable with that business. Okay,
over to you, Andrey, your time in the hot seat. What's your favourite tech stock right now and why?
My favourite tech stock right now is Xero. They have a world-class management team now, with the management team having experience from Google, Uber, Okta, and other top tech firms. They have dramatically accelerated their product velocity. They're launching that generative AI Copilot, but also improving core products in the UK and the US around payroll and payments. They're also conducting early marketing experiments, which can help them reaccelerate the growth of top line as well. I've just come back from the UK, from XeroCon, from their flagship conference, and the feedback from the accounting partners is overwhelmingly positive for those product enhancements. And the structural trends are in their favor in the UK market. So UK accounting market is going through a private equity-driven consolidation, and those large accounting firms who are acting as the consolidators choose to standardize on Xero as opposed to their competitors, which is accretive to their market share. At the same time, the smaller end of the accounting firms are increasingly finding products like tax and payments and eventually payroll fit for purpose for their needs. So Xero can increase their share of wallet with those accounting firms as they expand from just using core accounting to using more of the Xero product suite, while the middle is disappearing as it's being acquired by the larger players.
Okay, well, I hope you enjoyed that episode of Buy, Hold, Sell as much as I did. If you did, why not give it a like? Remember to subscribe to our YouTube channel. We're adding so much great content just like this every single week.